Hello and welcome to the Scan of the Markets webinar with me, David Madden. I'm a market analyst with Equity Capital in London. Equity Capital is one of the many companies within the overall equity group. And then, of course, we obviously have FX Pesa in Kenya and Equity Nigeria, as well as various different subsidiaries. Now, before we actually get into the actual live update on what's going on with the markets, let's just take a quick scan of the risk warning here. And essentially what it states is anything that I've covered in today's webinar is only purely my own thoughts, opinions, and comments, and it should not be construed as trading ideas or investment advice. Quickly moving on to the next page of the risk warnings. So quickly run through the major markets. The first chart I'll start off looking at is going to be gold. Gold's obviously had a major move to the upside this week. There's been a various different kind of fundamental reasons behind the overall move of gold. First of all, the flight to quality play. For those of you who've never heard that terminology before, it essentially means whenever there's major uncertainty in the financial markets and assets that are deemed to be a bit riskier, such as stocks, when they start tumbling, traders and investors start scrambling around for assets that are perceived to be lower risk, such as gold. So hence the expression flight to quality. Essentially, traders are selling off the likes of stocks and shares and buying up gold. This is one of the reasons why we saw a sharp move to the upside in the gold market. Gold at its highest level in 19 months earlier on this week. What's also been a factor in the move in gold has also been a move in the US dollar. Now, during the height of the violence between Russia and Ukraine, we did see a strong US dollar, but more recently, and the last couple of days, we have seen a pullback in the US dollar. And broadly speaking, whenever we have seen declines in the US dollar over the years, that's tended to give gold a benefit. Why is this? Well, gold, like other commodities, is traded in US dollars. So whenever we have weakness in gold, we usually have strength whenever we have weakness in the US dollar, we tend to have strength in gold, and vice versa. Usually, not always, but often when we have a very strong rally in the gold market, that usually puts downward pressure. Whenever we have a strong rally in the dollar, that puts downward pressure on gold. And also, what's also been a topic today is higher inflation. Earlier today, we saw US inflation hit its highest level a new 4-year high, and moved from 7.5% to 7.9%. Inflation here in the UK, where I'm based in London, is at its highest level since the 1990s. Inflation in the Eurozone is at a record high. So higher inflation is a major concern around the world. And with that, gold has typically been seen as a kind of a hedge against inflation. So people say to themselves, the price of assets is going up. If your cash in your bank account if your cash in your bank account is earning you next to zero, because of interest rates in many Western countries is almost zero, and inflation is running at 4, 5, 7, 8%, you're essentially losing money. So the idea is that to hold assets as a way of protecting yourself against rising inflation. So all of these factors have been a reason why we've seen an upward move in gold. Like I said, a few days ago, gold traded up around 2070, its highest level since August 2020, but a 19-year high. The fact that it came within a few dollars of retesting its previous all-time high really highlights how bullish this upward move has been. Although we have seen a bit of a dip in gold in the last few hours, we've actually managed to get back above the 20-period moving average. By the way, I'm actually just looking at 4-hour charts here. While gold continues to hold above these 3 simple moving averages, it's like the broader upward trend will continue. Rally higher from here, could see it retest 2070, and a break beyond that could see a target 2,100. If we do see any continuation of this short-term downward move, if we do see any further losses in gold from here, support could be found from this area here at 1970, and right below that could see a target this zone here at 1960. Looking here at euro dollar, there's been a few things that's been really driving the euro in particular, but also euro dollar as a currency in the last few days, largely to do with the fact that major economies in the eurozone, such as Germany and Italy, and to a lesser extent the Netherlands, they're heavily dependent on Russia on gas imports from Russia. Obviously, we're in the middle of a quite a tense standoff between Western governments and Russia, where it seems to be kind of heading down to the next phase, the second phase of the Cold War, a bit of an economic war between the two sides. I'll come on to it at the next chart, or the next couple of charts. But we've obviously heard from the US this week about banning Russian gas, Russian oil exports. There's a constant fear that if Russia were to turn off the tap, as it were, in relation to gas, that could have a major negative impact on the likes of the German economy, the Italian economy, and to a lesser extent the Dutch economy. What's also been going on with the eurozone? Well, we've seen, we talked about higher inflation in the US. We're seeing rising inflation in the eurozone. Inflation in the eurozone is at its highest level on record. We've also seen signs of cooling growth in the eurozone even before we had the war in Ukraine. So a combination of these factors is essentially weighing on the single currency. Also today, from the European Central Bank, the central bank today kept its interest rate on hold, meeting expectations. But the ECB essentially dramatically increased its inflation expectations for this year and for next year. At the same time, this year's growth forecast was cut at a fairly considerable rate. So it's kind of a worst of both worlds, whereby you're expecting prices to continue to rise at a faster rate, and at the same time you're expecting growth to kind of go down a gear or two. So worst of both worlds as far as the single currency is concerned. So we can see here we've had a very aggressive decline in the euro. Earlier this week, the euro fell to its lowest level, I believe, since May 2020. We're talking not too far, well over a 18-month low, not too far away from a 2-year low on euro dollar. Although we have rebounded in the past 48 hours, we've actually managed to kind of fall back below these two moving averages. We're back below the 50-period moving average, where the market rallied. It didn't even get as high. It didn't even break above the 100-period moving average. So, and it seems to me, while we continue to hold below these two moving averages here, it's likely the more medium-term bearish trend will continue moving lower from here. We could be looking at retesting the recent lows of 1.0805, and a break below that could then see its target 1.0700. If we take a look at the price action in the last few days, we can see that very much a short-term upward move is in play. If you look at the MACD indicator, although positive momentum is in decline, which suggests that the bulls are running out of steam, the fact that momentum is still in positive territory suggests that the bulls are still in control. So if we do see a continuation of this short-term upward move in euro dollar, where could we target? Well, we could have the target this zone here around 1.1142, and a break beyond that, and that could target this metric here at 1.1245. Looking here at the US dollar, the S&P 500, the US 500. Like other stock markets around the world, it's obviously come under setting pressure due to the war in Ukraine. Essentially, traders are seeing the violence that's taking place there and are essentially cashing in assets that are considered to be higher risk, such as stocks, and buying assets that are lower risk, such as gold, which I touched on a couple of charts ago. We can see here that even though we had a bit of rebound in the last session or two in the US 500, we've actually managed to kind of can back some of those yesterday's gains. We're back below all three of these simple moving averages. That ties in with the more medium-term downward trend, which ties in with a much more longer-term downward trend in the US 500. If we continue to move lower from here, we could look to retest the lows earlier on this week at 41.41, and a break below that could then retest the lows of late February, around the time the Russian invasion of Ukraine began, and that comes into play in around 41.06. If you take a look at the RSI, it's been edging a bit lower recently, suggesting the price bias is in the downside. But at the same time, the RSI is currently sitting in around the middle of the range, suggesting there's no strong price bias in either direction. It's worth noting, though, that the lows that we did see earlier on this week in the US 500 were still comfortably above the lows that were set in late February. So if you can manage to hold above this zone here at 41.41, it's possible that we might see the market stage a bit of a rally from here. If we do manage to rise from here, we could look to encounter resistance from this simple moving average here, the 100-period moving average, and that comes to play at 43.22. And a break above that could target this peak here, the peak here of early March in at 44.21. Coming on now to the DE30, there's obviously a few things going on in relation to why has the German market been under such incredible pressure recently? Because earlier on this week, the lows of this week, at one point we were down over 20% from the all-time high that was set in January. So it didn't actually close in bear market territory, but it certainly entered bear market territory. And with that, they kind of sent out the fears that maybe recession's on the horizon for Germany. Why is there a potential recession on the horizon for Germany? Well, we already saw quite poor growth figures from Germany in the final quarter of 2021. We saw negative growth. 2020, as we know now, the first few months of 2022 hasn't gone off to a great start. So the recession fears were already kind of been talked about even before the Russian invasion of Ukraine. As I mentioned a few minutes ago, Germany gets about half its gas imports from Russia. So once again, there's always the looming fear that Moscow might turn off the tap. So, and then adding to that, the European Central Bank for the last couple of years has been operating an extremely generous stimulus package. That's coming to an end. The PEP, the Pandemic Emergency Purchase Program, is coming to an end this month, and the Asset Purchase Program is coming to an end next month. So, to be fair, the Eurozone economy and the German economy is in much better shape now than it was 18 months ago. But still, the removal of that stimulus is also something to be mindful of as well, especially in a period of major uncertainty, such as a war going on in Eastern Europe. We can see here that in the last few hours, we've been moving lower on the DE30. We're back below these two moving averages. Once again, I'm always looking at a 4-hour chart here. As you can see, here's the 4-hour chart I'm looking at. We're back below the 50-period and the 100-period moving average. If the broader bearish trend continues, we could look to head back down toward this area here around 12,973. And then if you do break below that, we can then be looking at retesting the lows that were set earlier on this week in around 12,115. If you do manage to actually stage a rally from here, and if you can manage to kind of hold above this zone here around 12,973, it's possible that the more kind of short-term upward trend could continue. Should that be the case, we could potentially look to target this area here around 14,676, and a break above that could target this zone here around 14,902. One of the major focuses of the kind of Russian-Ukraine conflict has been, of course, oil. Russia being a major exporter of oil. Earlier this week, we heard from U.S. President Joe Biden, who stated that the plan to actually ban the purchase of Russian oil exports. The UK is also looking to phase out Russian oil exports, and with the way things are going, we might get other countries around the world to actually to follow suit. So that's been a factor during the week. What's also been going on is higher inflation. Inflation is one of the key drivers of high inflation is in fact high energy prices, and it becomes one of those kind of self-fulfilling prophecies almost, whereby people start to look at the rising costs of energy costs, seeing oil prices go higher, then they think to themselves, well, what if prices get higher and higher and higher, then I'm going to have to pay more for my energy down the line. So it's almost as if there's a scramble for oil right now to try and head off even higher energy prices 3 months, 6 months down the line. That in turn ends up actually driving up energy prices or oil prices in the near term. There's also genuine concerns about the actual supply levels. As I mentioned, from time to time, there are concerns that Russia would kind of turn off the gas, as it were, turn off the tap. And there are logistical concerns as well in relation to oil lines and gas lines running through Eastern Europe over to Western Europe. So the concerns with the conflict, what's going to happen there? Earlier on this week, or a couple of days ago, we saw UKOIL hit a new 14-year highs, which really kind of highlights how bullish the upward move it was. To be fair to it, we did see quite an aggressive move lower. We did see UKOIL briefly trade below the 100-period moving average. It's managed to stabilize in the last few hours. The more medium-term trend is very much to the upside. The short-term trend is to the downside. If you continue to hold below these two moving averages, the 20-period moving average and also the 50-period moving average, it's like in the near term, the short-term downward trend will continue. Moving lower from here, we could hit the target at the recent lows of this week in at 104.29, and a break below that could see a target this zone here around 126. If on the other hand, the more medium-term uptrend does continue, and we do need to kind of build on the ground from here, we could potentially find support from, resistance rather. We could encounter resistance from this moving average here. The 20-period moving average comes into play in around 117.28, and a break above that could target this zone here around 122.87. And of course, if you break beyond that, we could then be looking up towards $130 or even $135. And speaking of the oil market, the Canadian dollar is quite heavily tied in with what's going on in the oil market, because Canada has a relatively large oil and gas industry, and therefore if we do see sharp moves in oil, we usually see sharp moves in the Canadian dollar. But at the same time, what's also been going on in the mix is that the US dollar itself has acted as a bit of a safe haven play during the uncertainty of the war going on in Eastern Europe. So in the last 24, 48 hours, I mentioned how we've seen a pullback in the price of oil. In turn, earlier this week, we saw a sharp move to the upside in the USD versus the Canadian dollar. The USD had its highest level in several months. Really kind of the USD CAD hit its highest level in several months, really underlying how bullish this recent upward move has been. We have seen a bit of a pullback in the currency pair, but that being said, we are seeing because we have seen a bit of a rebound in oil today versus yesterday. And in turn, we've seen a move to the downside in the currency pair. That being said, we are still holding above these two moving averages, the 50-period moving average and the 100-period moving average. So if we continue to hold below those two metrics, it's like the more medium-term upward trend will continue. Moving higher from here, we could be targeting 1.2900, and then beyond that, we could then be looking to target 1.2963. If you do see a continuation of this short-term downward move in USD CAD, we could look to retest the 100-period moving average here, and that comes into play around 1.2746. And a break below that could see a target this zone here in around 1.2684. Now, if you do see any kind of moves to the downside, beyond that, we could then be kind of retesting the lows here that were set in late March in around 1.2586. What's kind of on the agenda in terms of macroeconomic news for fundamental news? Well, the Federal Reserve have their interest rate decision next week. There's chatter that the US Central Bank are going to hike interest rates by 0.25%. It's almost as if that's a done deal, and then traders will be looking at the commentary and the language next week to try and figure out how many more interest rate hikes are we going to have this year. Keep in mind, in December, the Federal Reserve, the dot plot forecast suggested there's going to be 3 rate hikes in 2022. By the January meeting in this year, the Fed funds futures market began to price in 5 interest rate hikes from the Fed this year. Now, traders remain divided over how many hikes do we think the Fed are going to have. Some people are saying it could be 5, some are saying 6, or some are saying it could be 7. Next week's Fed meeting will be important to try and figure out the language they use could give us a clue of how many interest rate hikes they're going to think about. I've already talked about the rally in oil. Fair enough, oil retreated from its 14-year high, but still, in the grand scheme of things, it's still looking fairly expensive, and the more medium-term uptrend is still in oil. If oil does continue to move higher from here, we could see a continuation of this downward move in USD CAD. At the same time, though, if we do see, we've already seen declines in stock markets in Europe and the US today. If we see another wave of selling in stock markets around the world, that could push traders to kind of seek out safe haven assets. And recently, we've seen a bit of safe haven status be come into play with the US dollar. So we have seen a bit of a safe haven play in relation to the US dollar recently. In relation to the kind of the charts and the topics, that's all from me from this evening. Thank you for those who are tuning in, and feel free to actually kind of tune in on a regular basis, because I'll be here every single Thursday giving my overview on my kind of screenshot of the markets. So once again, thank you for your patience and appreciate it, and hopefully see you soon.